Welcome to Share Views. This is a special episode on uranium and all things uranium related. We are joined by my co-host Amanda Van Dyke, who's a mining sector fund manager, and by Paul Atherley, who's the CEO of Berkeley Energia. How are you today, Paul?
Very, very well, Zach. Good to be here. Good to hear with Amanda. She's taken up this role as a fund manager, and I understand she's already a star performer so far this year. So well done to Amanda.
Yes, only up about 100%, but maybe you'll do better by the end of the year.
Right. She probably needs to buy some more uranium stocks.
Well, no, that's the point, though, that Amanda's focused on gold, but uranium has been a bit of a dog, let us say, over the recent past. What's the explanation, and is there going to be any change in that state of affairs?
Well, I think the reality is, over the last 5 years, and Amanda's more of an expert on this than me, is the uranium sector has flattered to deceive. It's been in the doldrums, near the bottom, and I think every year experienced analysts have come out and said, this is the year for uranium, and it hasn't happened. So there's been this sense of deja vu every year. But I think now we're looking at the point where it could be this is the point that turns. And for me as an operator, me as somebody who's come from the industry, the bit when you know it's going to turn is when you see supply side destruction, people closing mines. So right now, Cameco are shutting in production. For me, that's a very, very good sign.
And how come the uranium price remains in the doldrums, but your share price, the Berkeley Energia share price, has gone up?
Partly due to the new management, Zach, of course, you'd appreciate that. But no, the reality is we have this fantastic deposit called Zona 7, which is 30 million pounds of our 90 million pounds of our resource. And we've brought this to market at a time when, and as Amanda has pointed it out to me, I think the average production cost in the industry is about $39 a pound, whereas the spot price is $25 a pound. So nobody in the world's making any money. And here we come along with a project that can produce life of mine uranium at $17.50. So we're already right at the bottom of the cycle. We're already got an EBITDA margin of something like 30% right now at the bottom of the cycle. So we're probably the best placed uranium project in the world today to make money today, but also be there for when the uranium price turns.
So in a way, this is a double investment situation. It's a play on uranium as well as being a play on the resource that you have under the ground.
Yes, I think for, shall we say, the more astute investors, non-momentum investors, you're not going to buy lithium now. You're not probably going to buy gold now. You're going to sit back and say, which of the commodities that's bombed out is the next one to turn? You talk to somebody like Amanda. It's remarkable that last year no one would go near thermal coal. Thermal coal's up 50%. No one heard of coking coal. Coking coal's exploded this year. You can't get enough. And so people are saying, which of the bombed out commodities is the next one to move? All I can say is I look at my stock, and the people who are buying it are not retail investors so much, but the big funds. So we've got BlackRock, River Mercantile, Majedi, and just this morning, Fidelity have gone through 6% buying on market. So here you have the smart guy sitting back, making a decision and saying, we think this company can make money at the bottom. We want to be in it for when the uranium price turns.
Well, I can understand why investors want to get into your company, but I still don't see on the broader scale uranium as opposed to coal. I mean, the demand for uranium, how is that going to play out over the near term?
I'll let Amanda can address that. We were talking about that before.
Well, I think realistically, I think uranium is set just on present numbers to go up at about 2.5% demand growth per annum. As Paul mentioned earlier, there is no more supply coming online at these prices. The average cost of production, and that's the cheap production, is about $40 per pound of uranium. And so nobody can afford to produce at a loss. They can do it for a very short period of time, but not a long period of time. And this year is when all of the fund managers are saying, okay, the demand and supply balance has finally turned. And so it's going to turn sometime. Now we know that the market can remain irrational occasionally for longer than we can remain solvent. But we do know that when you think something's going to turn, but you want to hedge your bets when you're buying in the market, you buy the lowest quartile of costs of production when it comes to mining, and you buy the bigger companies, like the really big boys that also have the very low costs of production. Because when the market turns, we know those will go first, and we know those have downside protection. They can't go any lower because they're producing a certain amount of cash even now. And that's why a company, like despite uranium prices being at 12-year lows, companies like Paul's are doing well.
But haven't we got a situation with uranium that there is fear in the market after the accidents the accident in Japan especially, and it's going to take a long time for confidence to build again?
We're way past that point. From my perspective, I'd like Amanda from her perspective. Number one is that even Japan is opening up new reactors, putting them back on stream. But the reality is the world's making a choice. If you want clean energy, there's only scalable clean energy. There's only really two places to go. Renewables, which means sticking more windmills in the North Sea, in the case of this country, and nuclear. They go together. So there isn't a choice. So renewables and nuclear are part of the long-term clean energy solution.
I would also say that nuclear is still the cheapest, cleanest form of energy. It's by an order of magnitude still cheaper to produce every kilowatt hour of nuclear energy than it is to produce wind or solar. Even though those costs are coming down, it's still the cleanest and cheapest form of energy out there. And cheap matters too.
So we're all happy to live around Hinkley Point or Sellafield, those places. There's no problem.
It's interesting, actually. My stockbroker, who works here in London, he tells me this story. He lives in Essex. He lives near the nuclear reactor called Bradwell in Essex, and the Chinese are hoping to expand it. And he loves it, he said, because he goes sailing, and he says all the warm water from the coolant from the reactor comes out. And the fact he's lost all his hair, his kids have got 3 eyes is another thing. But no, the reality is that those people who live close to nuclear reactors are very, very comfortable with it, which is the opposite to onshore wind. Onshore wind in this country has a dreadful time. So if you seek planning permission for an extension for an existing existing nuclear facility in this country, you will get support locally. If you say, I want to put onshore wind turbines, you'll have a much greater difficulty.
But isn't the reality that, well, for me, because I'm still, let's say, skeptical about uranium, especially living next to a plant, is that we have an energy crisis. So like it or not, whether I like it or not, there has to be nuclear. We have to go nuclear.
The crisis is one of policy, because we've made the decision, an intergovernmental decision. COP21 in Paris in November last year made it very clear that we've got to decarbonize our energy production. So that means the cheapest form of energy in the world, coal, it's abundant, it's free, is being phased out. So Amber Rudd, when she was in the role, Secretary of State of Energy, said within 10 years in this country, we're going to phase out all unabated coal-fired power stations. In other words, coal will go to zero. In that case, you're left with the only two scalable clean energies are the suite of renewables and nuclear. Gas is only a low-carbon bridge from carbon to clean energy. So it's a policy decision rather than necessity. Amanda, how am I doing?
No, I just also think that while I like and respect renewables, we're not at a stage yet. Renewables take a lot of room. They actually take up a lot more room than a nuclear power plant per kilowatt hour they produce. Where are you going to put all that wind? Where are you going to put all that solar? We simply can't phase out coal without nuclear. There is no other option in the world. We're kidding ourselves.
Completely agree. Just to add the stats to that is to meet the 2030 carbon targets for this country, if you had no scale of the nuclear, you need 37,000 onshore turbines, wind turbines, from 5,000. So you basically have the island covered with them. So I completely agree with Amanda, it's not feasible. So it has to be renewables and something else.
I just want to go, maybe it's a lap of honour, I don't know, but Berkeley Energia share prices doubled, tripled over the last year. It's a success story as far as the small cap area is concerned. Somebody looking at it now and thinking, well, actually, this is going to get dizzy heights here. How can we look at this company in let's say, a cool fashion and just stand back from it, stand back from the share price rises?
Very, very simple. Two simple stats. Number one is when we're in production, our annual cash flow will be bigger than this market cap. And the evidence of that is Dave Talbot from Dundee Securities came out today, just lifted the rating on the stock. discounted rating. He's valuing us at £1.35 a share. So we're at 40 something now. So we've still got 3 times to go. Plenty of headroom in the stock.
Right.
If I might also, one of the things that becomes the gold market actually, the uranium market reminds me a lot of where the gold market was this time last year, in terms of the majority of producers were slightly losing money. They were trying to keep the lights on, but the price had gotten so low that plants were closing down, and that's happening throughout the uranium industry. When you get to that tipping point where it's just they simply cannot keep the lights on anymore at the prices, suddenly things change, and it happen when commodity prices turn, they turn hard and fast. And if and when they turn hard and fast, and you have things like coal going up 50% in 1 year, gold's up 27% year to date, that's how uranium is going to turn when it turns. And when that happens, these companies are leveraged plays on the uranium price, and they'll go up significantly more than that again.
Well, I mean, I'd probably be happier with looking at the Barclay here on its own, but for me, it was a surprise that you had one of the biggest turns, the hardest and fastest turnaround in commodities of all shapes and sizes. Even crude oil turned around in January, and uranium hasn't really moved.
The story from the industry history is in 2005, the spot price, which only represents sort of 20 odd % of the actual uranium traded in any 1 year, was sitting at a very low level. It's sitting $15 a pound or something. And it'd been there for sort of 5 years. And every year the utilities let their coverage fall away, and they didn't have very much cover because they just go to the spot market. And suddenly one day the spot price jumped above what's called the term price, which was $15 higher. And then people put in a contract, and then another one, it panicked. And the uranium price ran from $15 to $130 a pound. So exactly what Amanda's talking about. You don't know when it's going to go, but when it goes really hard.
Right, and apart from your company, what are there any other ways you think of getting exposure to?
Well, again, Amanda makes the really good point. There's probably 2 points of entry back into the industry. One is to have a look at the major player. I think Cameco's off something like 50% this year. That's probably a good entry if you're a big generalist fund and you don't want to take us. You want a big diversified play. And the other one is clearly us. Not just because it's Barclay Energy, but clearly the Salamanca project, because it's right at the bottom of the cost curve. It's the one it's going to make really, really good money. So I think they're the 2 entry points.
On that note, Paul Atherley, CEO of Barclay Energy, thank you very much for coming in today, and thank you to my co-host Amanda Van Dyke, mining sector fund manager.